Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, last week we were supposed to have begun our coverage in anticipation of the budget for 2019-2020. Adverse weather would have stopped that to some extent, but we're back again today, and we're looking today at the expenditure side of the budget equation. Let's get straight into it. And in terms of government expenditures for the past several years, well, it would have peaked at around $62.8 billion in fiscal 2013-2014. And you would have seen or observed over the past several years a consistent decline in government expenditure to a low of $47.6 billion in that fiscal 2017-2018 period. Projected for this fiscal year, total government expenditures were supposed to increase to just around $51.8 billion. That's actually at the mid-year, it was revised to just a shade over $52 billion, with most of that expenditure, around $47 billion, attributable to current expenditure, and just about $5.2 billion attributable to capital expenditure. Now, when we look at where a further breakdown of where money is being spent at the national level, we can see for the October to July periods for the past several years, most of it has been going towards transfers and subsidies in that orange color at the bottom of the graph. As a matter of fact, for October 2018 to July 2019, $22.7 billion has been spent out of a total $40.7 for the year thus far. That's the first 9 months of the fiscal year on transfers and subsidies, and that number has averaged just around 55% over the past several years. The next most significant contributor in terms of spending has been wages and salaries. That's been fairly constant at around $7.6 billion over the past several years. Some points to note: capital expenditures actually declined from around $5 billion in the fiscal in October 2014 to July 2015 period, and it's now just at around $2.7 billion for the period October to July 2018-2019. So some questions as to whether or not that $5.2 billion capital expenditure figure will be met in the last three months of this fiscal year. Now, overall, what does that mean? While expenditure has come down to some degree, revenues have fallen a bit faster, and it means that overall we are still spending more than we are earning as a nation, and that's measured by the overall fiscal balance, which peaked at negative $13.5 billion in fiscal 2017 and is projected to still be around $4.6 billion for the fiscal year 2018-2019. And a reminder to most of you all, the budget is going to be read on October 7th. Later this year, later in the next month, and we look forward to seeing all of those revised figures. Now, how are we going to continue? How are we going to continue spending more than we're earning? Well, one, we know that it's not sustainable in the long run, but there are some measures that the government can use to fund this expenditure. One being drawing down on savings, and if we look at the Heritage and Stabilization Fund, we see that the Heritage and Stabilization Fund's value has increased quite significantly over the past several years, from about $1.4 billion in its start in 2007 to its current level of just around $6.2 billion as at June 2019. Now, interesting to note, net contributions have been about $3.3 billion, peaking at $4 billion US back in September 2014. And most of, almost 50% of the value of the fund, of the Heritage and Stabilization Fund, has been generated through investment returns, which is comprised, and that investment portfolio is comprised of about 60% bonds and 40% equities. So certainly from an investment perspective, the HSF has been doing well. But there's only so much that can be drawn from the HSF to fund expenditure. The more likely avenue in an environment particularly starved of fixed income opportunities for investors, whether it's retail, individual, or institutional investors, has been and will continue to be borrowing through government issues and other borrowing means. However, we can see that debt to GDP has been increasing over the past few years, from 49.5% in March 2015 to 60.1% in March of 2019. Nonetheless, it's still within the government suggested levels of 65% of debt to GDP as a ceiling. Some interesting trends: domestic debt to GDP in that blue has been fairly stable at around 43.5 to 44%. The factor that's increasing has been external debt to GDP, which has increased from 8% to 16.3%. So what are some of the borrowing initiatives on the horizon? Well, the housing bonds have been talked about. At the last budget, there was some mention of NIF Type 2 borrowing, but nothing has really been heard about that. So we look forward eagerly to that October 7th reading of the budget, where we might get some more clarity as to borrowing initiatives from the government. That's it for this week's edition. For more information, you can give us a call at 226-8773 or 2-BOURSE. Email us at invest@boursefinancial.com or check out our website at www.bourseinvestment.com. Have yourselves a great investing week. This has been the Bourse Report.